You have paid rent this month. You paid it last month. You will pay it next month. And if you are like the 34 million American households currently renting, you will do some version of this calculation at some point. Probably late at night, probably after opening a lease renewal with a number higher than last year. And you will add up what you have paid so far and realize that the total is large enough to have purchased something if the system had been designed to let you. It was not designed to let you. That is not cynicism. That is the structure. I have been working through a set of handwritten ledgers from Lancaster County, Pennsylvania for 3 years. 44 years of financial records belonging to a man named Ezekiel, documenting every significant economic event in his household and community from 1887 through 1931. In those records, there is no rent column, not one entry. Not for Ezekiel, not for any family in those pages. An entire community of hundreds of households across multiple generations in an era when tenant farming dominated rural America, and not a single rent payment flowing outward to a landlord. What they operated instead was a system so structurally efficient and so threatening to the landlord class that understanding it changes the way you read every lease you have ever signed. By the time this video ends, you will know exactly how it worked and why the third piece of it, buried in the back of Ezekiel's final ledger, is the part the real estate industry has the most reason to hope you never find. The average monthly rent in America today is $1,700. Over a decade, that is $4,000. Money that left the household permanently, built nothing that can be passed to the next generation, and exists now only as profit in someone else's ledger. Meanwhile, the landlord collecting that rent is building equity every month on an asset the tenant is financing. The tenant assumes all the financial burden of occupying the property and receives none of the ownership benefit. Every dollar of rent paid is a dollar that cannot become a down payment. The system was not built to help renters become owners. It was built to keep the transaction flowing indefinitely in one direction. In an era when tenant farming locked millions of American families into perpetual tenancy with no realistic exit, Ezekiel's community maintained continuous property ownership across multiple generations, without a single rent payment flowing outward to a landlord. No mortgage industry, no government housing program, no financial product that did not exist within the community itself. The infrastructure of the modern rental market had no foothold in their economy because the system they had built left no gap for it to occupy. What Ezekiel's community operated was not a lucky accident of timing or geography. It was a system, precise, deliberate and replicable, built around a single structural insight that the modern rental market has spent 2 centuries obscuring. The cost of occupying land is not the same as the price a landlord charges to occupy it. Those 2 numbers are separated by profit margin, financing cost, vacancy risk, management overhead, and the compounding return a property investor expects on capital deployed. Strip every one of those layers away, and what remains is the actual cost of occupying the land, the maintenance, the tax, the community obligation. The Amish paid only that number, the actual cost, nothing more. And they structured their entire land system to ensure that the layers between that number and what a commercial landlord charges could never accumulate within their community. Because no community member was permitted to position themselves between another member and the land that member needed. The mechanism begins with what the community called the Kaufgemeinschaft, the purchasing fellowship. When a young Amish family was ready to establish an independent household, they did not enter the rental market as a bridge to eventual ownership. The rental market, as a transitional stage, did not exist for them. There was no interim period of paying someone else's mortgage while saving toward a down payment that inflation was simultaneously pushing further out of reach. Instead, a circle of established community households, typically the extended family network, combined with several trusted Gemeinde members, pooled capital to fund the land purchase directly. The terms were set within the community. No interest, repayment on a schedule the purchasing family could sustain without financial strain, and a clear end point, at which the land title transferred completely and unconditionally. No origination fee, no appraisal requirement, no 30-year amortization table, designed to ensure that the first decade of payments went almost entirely to interest rather than principal. The transaction was between people who shared economic stakes in each other's outcomes, and it was structured accordingly. The mathematics of this against conventional rental are almost too stark to present without qualification, but the numbers are real and they are the industry's own. A family renting at $1,700 per month for 10 years pays $204,000 and owns nothing. A family purchasing a modest property through a Kaufgemeinschaft arrangement with the same $1,700 directed toward community loan repayment instead of rent has, at the end of 10 years, eliminated the loan, holds a free and clear title, and has built the asset base required to participate as a lender in the next family's purchase. The dollar amounts are identical. The outcomes are not comparable. Ezekiel's ledger contains a specific entry I returned to more than once while working through those pages. In the spring of 1896, a young family in his district, I will call them the Yoders, which is common enough in Lancaster County records to be appropriately anonymous, completed their final Kaufgemeinschaft repayment on a 22-acre parcel acquired 9 years earlier. The entry records the amount, exactly the original purchase price, no cent added for interest or fees. And in the margin, in handwriting I believe is Ezekiel's own, a single German word, fertig, finished, not relieved, not celebratory, finished, the way you note the completion of a task that was always going to be completed, because the system was designed from the beginning to produce exactly that outcome. Now, here is where the story requires the turn that most housing finance content avoids, because it implicates an industry that spends heavily on advertising and political influence. The rental market, as it exists in America today, was not an inevitable outgrowth of natural economic forces. It was shaped, deliberately and continuously, by policy decisions that made ownership harder to access for people without existing capital, and made tenancy the default arrangement for anyone who could not clear the barriers the ownership market erected. Down payment requirements, credit score thresholds, debt-to-income ratios, zoning laws that restrict land supply and inflate prices, mortgage structuring that front-loads interest so that the first decade of payments builds almost no equity. Every one of these mechanisms functions as a filter that keeps the rental market perpetually supplied with tenants who might otherwise become owners. The National Association of Realtors reported in 2023 that the median time between a first rental and a first home purchase in America has stretched to 11 years. 11 years of rent payments, averaging over $180,000 in total, before a single dollar of ownership equity is established. That 11-year gap is not a natural feature of the housing market. It is the distance between where the barriers were set and where most people start. The National Low-Income Housing Coalition publishes data annually on what it calls the housing wage, the hourly income required to afford a modest two-bedroom rental without spending more than 30% of income on housing. In no state in America does the minimum wage meet that threshold. In no state. That is not a market inefficiency. That is a market performing exactly as the participants who shaped its rules intended it to perform. The Amish did not lobby against these policies. They simply never entered the system those policies governed. The Kaufgemeinschaft operated entirely outside the conventional housing finance market. No mortgage originator, no title insurance requirement, no appraisal contingency, no 30-year amortization schedule front-loaded with interest. The transaction occurred between community members under community-established terms, witnessed and recorded by community elders. The regulatory apparatus that makes conventional home purchase expensive and slow simply did not apply because the Amish were not using the infrastructure that apparatus was designed to govern. And this is where the entries in Ezekiel's third ledger, the ones I want to be careful about presenting precisely, reveal the layer of the system that makes everything else function across generations rather than within a single lifetime. The Amish maintain what those records describe as a bodenrecht, a land right registry kept not by any government body, but by the Gemeinde itself. Every parcel of land within the community's economic sphere is recorded in this registry with its complete ownership history, its current Kaufgemeinschaft obligations, if any exist, and its designated Weitergabe status, meaning whether it has been formally committed to transfer to the next generation upon the current holder's retirement from active land management. The Bodenrecht serves a function that no commercial real estate market replicates. It makes land within the community permanently unavailable to the speculative market. A parcel recorded in the Bodenrecht cannot be sold to an outside investor, cannot be converted to rental property for profit, and cannot be leveraged as collateral for commercial debt without community approval. The land stays in the ownership system. It does not become inventory in the rental market. Every generation that inherits through the Weitergabe protocol inherits free and clear, and every generation that enters the community as a new household does so through the Kaufgemeinschaft rather than through the rental market. The practical result, documented across those 44 years of Ezekiel's records, is a community in which the concept of paying rent to a fellow community member for the right to occupy land that community member owns does not exist. Not because it was forbidden by religious rule, though the values of Gelassenheit discourage exploitation within the community, but because the system was structured to make it unnecessary. Every family that needed land had a pathway to own it. Every family that owned land had an obligation to support that pathway for the next family entering the system. The Bodenrecht ensured that land could not be extracted from this cycle by a single generation deciding to profit from scarcity. The Kaufgemeinschaft ensured that capital was always available to fund entry, and the Weitergabe protocol ensured that the asset transferred to the next generation without the friction, cost, or delay that commercial real estate transactions impose. The system was self-reinforcing precisely because each of its three components depended on and enabled the other two. The modern legal infrastructure for replicating the structural core of this system exists and is accessible. Community land trusts, a legal entity that has operated in the United States since 1969 and currently holds over 225,000 homes in permanent affordable ownership, function on a principle structurally identical to the Bodenrecht. The trust holds land in perpetuity, outside the speculative market, and sells or leases the structures on that land to residents under terms that prioritize long-term occupancy and community stability over short-term profit extraction. Resident-owned communities, cooperative housing structures, and community development financial institutions all represent legal, operating expressions of the Kaufgemeinschaft principle. Interest-reduced or interest-free community capital deployed to fund ownership rather than perpetuate tenancy. The Champlain Housing Trust in Vermont, one of the oldest and largest community land trusts in the country, has helped over 2,500 households achieve ownership at costs averaging 25% below market rate, without a single dollar of landlord profit extracted from the transaction. That is not a radical experiment. That is Ezekiel's system, operating in a modern legal structure, producing outcomes his ledger would have recognized immediately. I am not selling anything. No guide, no program, no course. What I'm asking you to do is look at your current housing arrangement and calculate one number: the total rent you have paid since you first signed a lease, added to the total rent you will pay at your current rate until you either purchase or stop renting. That number, the full lifetime cost of tenancy, is the number the rental market never shows you on the first of the month when the payment is due. It shows you $1,700. It does not show you $200,000, $4,000 per decade. It does not show you the landlord's equity position growing in parallel with every payment you make. Ezekiel never calculated that number because he never had to. His community made sure the transaction it represented never occurred, not by restricting anyone's freedom, but by building a system in which the pathway to ownership was always open, always funded, and always more accessible than tenancy. Leave one number in the comments, the total rent you have paid in your lifetime, as honestly as you can estimate it. I read everyone. That number tells me what this community needs to hear next, because the Kaufgemeinschaft solves the entry problem, and the Bodenrecht solves the generational problem. But there is a third problem that Ezekiel's records address in a way I have not seen documented anywhere else. It has to do with what happens to land value when inflation runs faster than wages. And that story connects everything in this series into a single system. It is already waiting.